Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We're going to cover some key opportunities and risks for investors tied to developments around the world this week, and we're going to take your live questions from the chat on YouTube so you can ask us what's on your mind at any time by just entering it into the chat, and we'll get to those questions in just a few minutes after we share some of our latest insights. Now, of course, we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why, and things can and do change, so all the thoughts we share are subject to change as well. Of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Ghibley and Heather O'Leary here on the Global Strategy team at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As always, I'll be watching the chat questions closely, and we will get to those in a little bit. Jeff, can you go ahead and kick us off with a quick rundown on what we're watching this week that could move the markets?
Yeah, so today, Canadians are heading to the polls in a vote called by new Prime Minister Carney, who looks like he's in the seat to win there, given the momentum in the polls lately. The election focuses, of course, on economic sovereignty and the escalating trade tensions with the U.S., so certainly it's going to be on the eyes of investors today. This week, though, is full of data that will provide a window on the economy's performance and prospects here in the U.S. Up first on Tuesday is the Conference Board's Consumer Confidence Survey. When that index has fallen by more than 20 points in 3 months, we've always seen a recession. It was down 17 points through March, so we'll be watching that one carefully tomorrow. Now, angst over the economy may increase on Wednesday. We get the release of the first quarter GDP number, and it's conceivable that GDP might have even declined as consumer spending shrank, obviously tied to the consumer confidence number that I just spoke about. It's been soft in recent months. We'll have to see. Housing has continued to slide. Imports are way up in anticipation of tariffs. That's a drag on GDP because we didn't make those things here. GDP measures domestic production. And of course, DOGE cuts also ding some government spending as well. So we'll have to see how that fits together. The expectation's not for a negative number, but a negative number could be in the cards there and something markets could react to. We also could see some red flares going off for the economy on Thursday when the April ISM manufacturing survey is released here for the U.S. The index may drop below the break-even 50 threshold as global supply chains are disrupted by the U.S. tariffs and retaliation by China and the EU and Canada. And then the week's going to end with the all-important jobs report. You've got the payroll jobs number currently forecast to come in at 133,000 for April, down from March, give or take, which is the consensus. If employment increases by less than 100,000, you want to watch out. Markets might react negatively for that and other signs of stagflation in the U.S. economy. So a lot of U.S. economic data that'll be on our radar screen, of course, but we're watching the global picture. And one of those things is certainly earnings, right? Companies from around the world. This is the peak week for reports for Q1 earnings. On Thursday, we're going to hear from a couple American companies, Amazon and Apple, totally global operations. They're going to face some scrutiny over their supply chain strategies due to the impact of Trump's tariffs on Chinese imports. And several companies, including McDonald's, Coca-Cola, Meta, are expected to report this week. Weaker than expected results might come in. The market's bracing for that, given inflation, trade war, consumer concerns. So we'll have to see. But it's not all bad news for earnings. There are some other companies like Visa, UPS, and Exxon that are expected to meet or even exceed estimates, with some potentially raising their guidance due to factors like a weaker U.S. dollar. A weaker dollar actually translates into gains for companies that have a lot of overseas sales because, of course, they translate into more dollars and they're reported on a dollar basis. Also on Thursday, as were both Apple and Amazon's earnings, we're going to get the Bank of Japan meeting. Markets are expecting no change from the Bank of Japan to the current 0.5% policy rate, but another rate hike may still be on the way later this year, and they may signal that in their meeting. The yen's risen about 10% against the dollar this year in anticipation of that, and other factors, of course, driving the yen and the dollar. Finally, we'll be watching port traffic and supply chain data. This is an important week. It takes about 2 to 4 weeks for container ships to go from China to the U.S. West Coast ports. The last orders that were front-running the tariffs back in early April arrived well, last week, and that pushed volume at the US's biggest port well above normal. Volume was up 56% above normal last week. You can see here in this graphic that I just pulled from the Port of Los Angeles and Long Beach website. On the left side there, last week, 120,000. You can see at the bottom, change from previous year, up 56%. Huge gain, but look at the red numbers for the next couple of weeks because volume is set to plunge with tariffs kicking in and that lag time coming from China to the US down 10% from a year ago next week, or this week really, and then 33% the week after, and it only gets worse from there. So I hope you're all stocked up on all your favorite Chinese-made products because we could really start to see this pull back as memories of the pandemic shortages come to mind. Toilet paper might be one of those. Of course, the U.S. does manufacture toilet paper, but where's it come from? Mainly Brazil. It's made with eucalyptus pulp, and of course, U.S. import tariffs are also being applied to Brazil, as every other country. Of course, as those imports come into East Coast ports and Gulf ports, there could be some challenges there as well. So remember, there are supply chains within supply chains, even for toilet paper. So we'll be watching that carefully. And on the impact of these trade issues, last week adds to the updated forecast we've been getting from global economic forecasting organizations. So we've heard from the IMF, the OECD, the World Bank, and the World Trade Organization, with the IMF and the World Bank having their meetings last week. All of them have lowered their growth outlook for nearly all countries around the world, all regions, since the last forecast update around the start of the year. And that's shaved the overall outlook for growth this year around the world by 0.5 percentage point. Of course, that's a guess. The biggest hits were to North American economies, obviously U.S. tariffs, and then Canada and Mexico, very, very tied to that. The IMF did not forecast a global recession. In fact, the only country with a negative outlook for GDP was Mexico, with GDP close to flat at negative 0.3% is their forecast for this year, given that country's dependence on exports to the U.S. You can see in this chart here the changes to their forecast from their January update. So big downward revisions there to 2025 in blue. For Mexico, the U.S. and Canada, those are the ones on the left. The U.S. and the U.S.'s two biggest trading partners, followed by China, third biggest trading partner, and then much lesser hits to Japan, the UK, the world, the Eurozone, and then the 2026 hits, even much less for those countries. So relatively modest hits. We're talking about less than 0.5% this year for most of those countries, and then 0.2 or something in 2026. But the bigger ones, the most important ones, the U.S.'s closest trading partners, some pretty severe hits to economic growth here in the near term. So we'll have to watch out for that. But even more so, earnings are sensitive to trade than GDP. A much larger share of sales at multinational companies are tied to trade than GDP. And those are the companies that populate the major indexes around the world. Very high percentage of sales outside their home countries. And of course, tariffs have been a hot topic on earnings calls. You can see here, this is a chart of the number of times companies have mentioned tariffs in earnings call transcripts. We aren't even near the peak of the reporting season yet. That comes this week, but already you can see this big spike. Everybody's mentioning, I think like 90% of the calls have mentioned tariffs at some point. So it's a major factor for earnings as well. And the number of companies in the S&P 500 with downward earnings revisions by analysts, so taking down their forecast, is actually coming in very similar to the 2008 global financial crisis and the 2020 pandemic. The number of downward earnings revisions, you can see in this chart here, the blue line showing the number of downward earnings revisions for the companies in the S&P 500. We know there's 500 companies in there. Scale on the left, you can see the blue line really jumped up there. Again, not even at the peak of the earnings season yet, but really taking down numbers for this year. Really spiking up. The only other two times we've seen numbers like this, back in 2008, great financial crisis, global financial crisis, right? And then 2020's pandemic. Pandemic numbers were higher. Of course, we're not really through this earnings season yet, so we may still get more numbers. Interestingly, the orange line, I put it on here for contrast because I don't spend as much time on the S&P 500 as I do as the international picture, but the EFI index here of international markets not ticking up as much. Now, again, we've still got to get into this earnings season, but really this is an uptick, but not really that different than the average over the last 20 years. So far below past crisis peaks. And that just reflects, the somewhat less exposed earnings. Non-US earnings are just less exposed. Even in Mexico, So, for example, Mexico's GDP is now expected to be negative in 2025 due to the tariff impact, as I mentioned. But despite that forecast, Mexico's stock market is one of the best performers this year. It's up 22% measured in US dollar terms. And that's because, unlike the economy, most of the Mexican companies in the stock market are not exposed to tariffs. They really don't have, they serve the domestic market. They don't do any exporting. We're talking about Mexico's Walmart, its Coca-Cola distributor, its telecommunications companies. They're just focused on the Mexican market. So their earnings are insulated from tariffs in a way that economic growth is not. And that's an important distinction for investors. And it's why the earnings outlook remains brighter overseas than it does in the US, where all the US companies are really dealing with tariffs in some ways. All right, Michelle, let me get you in here. How are central banks viewing the threat of inflation from these tariffs? We know we've got that Bank of Japan meeting this week, but it's certainly something on the mind of all these central bankers.
Yeah, central banks are taking, all of them are taking a little bit different tacks to this. And the big divergence we're seeing is between the European Central Bank and the Fed. Now, the case for the ECB to cut rates is really stronger than it is for the Fed right now. Economic growth and inflation are lower in the Eurozone. Inflation came in at 2.2% for March in the Eurozone. It's expected to ease to 2.1% when reported later this week, and that's relative to 2.4% for the US. And then tomorrow we'll get the core PCE for the US. That's the Fed's preferred measure. It's expected to be 3.1%. Now, Powell recently talked about, the potential for tension between the dual mandates for the Fed. So there's upside risk to inflation, but also upside risk to unemployment. By contrast, ECB President Lagarde noted multiple downside risks to inflation in the Eurozone, and those include a stronger euro, falling energy prices, and the potential for Chinese goods to be rerouted instead of coming to the US, potentially to Europe, and put downside pressure on prices there. So the ECB can cut, despite Lagarde saying, there are many uncertainties, and the ECB would need to be data dependent and take a meeting by meeting approach. On the other end, we've got the Bank of Canada at its April 16th meeting, surprised by pausing rates. And they said they needed time to determine the eventual breadth and severity of US tariffs on Canadian goods and on other countries and their impact on inflation. Now, the central bank also got rid of its quarterly forecast, and instead they gave two scenarios of what could transpire amid the trade war. Now, the more positive scenarios showed growth slowing and inflation below 2% early next year, and that's down from the current core inflation rate of 2.85%. Now, Governor Macklem, he highlighted the uncertainty about what tariffs would be imposed, whether they would be reduced or escalated, and, quote, how long all of this will last. And he added that, rate policy cannot resolve trade uncertainty or offset the impacts of a trade war. And then, as you mentioned, we've got Bank of Japan this week. They're undergoing a very gradual hiking cycle, but they're likely to keep rates unchanged. Last week, consumer prices in Tokyo were reported, and those are a leading indicator for CPI for the country as a whole. Now, prices rose to 3.4% in April. That's using the Bank of Japan's preferred measure. And the acceleration in inflation to the fastest pace in 2 years really supports further rate hikes eventually by the Bank of Japan, but they're likely to wait to make policy changes due to, you guessed it, trade uncertainty. Additionally, a stronger yen reduces import prices and puts downside pressure on inflation. And then lastly, in China, the People's Bank of China is pursuing what they're calling moderately loose monetary policy. Now, that's the characterization that they've used since December. It's a little bit looser policy, but they have not cut rates or the reserve requirement ratio for banks yet this year. Yesterday, the PBOC deputy governor said rate cuts would happen at, quote, an appropriate time. Now, really, the constraint on the PBOC is the value of the yuan, where lower rates would weaken the yuan, and a weaker currency could prompt capital outflows. Additionally, a rate cut is not likely to fix what ails China's economy. The problem is not too high of interest rates. So a rate cut is unlikely to boost growth much. And the main issue has been weak domestic demand and, of course, now a reduction in exports to the U.S. Despite the economic pressure, late last week, the Politburo declined to add any new stimulus. Instead, they're relying on the very large fiscal deficit already in place for this year to fund economic support measures. And then yesterday, the vice chair of the NDRC, the National Development and Reform Commission, said they were, quote, fully confident in reaching the 5% GDP growth target for this year. And so it seems like China's not really in a hurry to act at this point, Jeff.
Yeah, we'll have to see. I mean, you and I talked about how much stimulus they'd enacted this year, a little more than last year. We're obviously tracking it very carefully, but they've got the firepower to do it. And maybe that's, maybe that's some of the part of this negotiating with, Trump and what they're going to try and do to, support their own economy. It's just interesting to see how this is evolving here. And I think obviously they were holding back a little bit ahead of April 2nd to see what that looks like. Now, sort of the rubber meets the road, and we'll have to see, what they do here, because obviously consumer spending isn't where they need it to be to hit those numbers. So they've got to get there somehow. They're not going to get growth through exports, at least not directly with the U.S. Interestingly, trade relationships are warming up a little bit with Europe. It was interesting at some of the sideline meetings at the spring meetings of the World Bank and the IMF, particularly the IMF this past week. Definitely, some European and Chinese members there are kind of, thinking about or talking about a warmer relationship and how to, what's the arrangement where Europe could bring in some of the excess capacity in some of those goods into Europe that China's dealing with right now, and so we'll have to see a lot of moving parts in what all this looks like from a trade perspective, but then how it impacts inflation and central banks as well. It's very circular here. Obviously, continuing pressure on the dollar. The dollar is basically flat today, maybe down just a little bit today, but interesting to see how the moves shape up with the dollar there, and the relative inflation picture in the U.S. suggesting, a relatively more hawkish stance by the Fed, but yet we just haven't seen that support the dollar at all. All right, Heather, let's see what the chat questions are coming in, see what we can opine on here this morning.
Great. Well, the first question has to do with U.S. Treasuries. What are our thoughts on them being sold by international parties, so private institutions, countries, and so forth? How might that affect the U.S. and global economy and the trade relationships that are currently contentious?
So there clearly are some signs that some private investors have been lightening up on treasuries for a variety of reasons. I mean, the dollar's been weak and sort of repositioning a little bit around that. I think often we hear, is this China, selling? I'm just looking at my screen right now. The percent of treasuries, outstanding treasuries owned by China back in, I'm going to take you back to 2010, was 14% of U.S. treasuries. I mean, that was a massive amount. It's now 2.8. It's just a tiny little fraction. It's just not very much. They have been selling. What if China sells? They've been selling. They've been selling for over a decade. And so I think the vulnerability to a sudden shock of a major holder like China or Japan dumping their treasuries just doesn't make sense. It obviously hurts them as they're selling. It's weighing on the assets that they own as they try and get out. At the same time, they just don't have as much exposure as they used to have. So this is more on the private side than the public side. Certainly, there's less flow we're seeing into treasuries from major governmental foreign holders, and that makes sense. If the U.S. is going to be buying less products from those countries, they're going to be getting fewer dollars. They have fewer dollars to then use to buy treasuries. So it just makes sense that the buying is slowing a little bit. And that's a problem for the U.S. because we need to actually not only continue that buying, we need to see the buying accelerate to fund our widening trade deficit. So budget deficit. So it's a problem even if it just slows, not that it reverses. But I think what we've seen here from a reversal perspective is more on the private side. We know private investors around the world, including domestic hedge funds, have been lightening up on treasuries here for a variety of reasons, and that might go on for a little bit. Hard to say exactly what that picture is. We've been recommending shorter duration. Our chief fixed income strategist, Kathy Jones, have been recommending longer duration, shifted back to shorter duration earlier this year, focusing on that. Really just focusing on, not having that longer term interest rate risk as, rates kind of whip around a little bit here, caught between inflation and potential inflation, potential selling by large investors, private or public. And then at the same time, concerns about the economic slowdown, sort of pulling rates down on the other side, real rates coming down because of the weaker economic picture for the U.S. So all of that fighting things out, creating a lot of volatility there, favoring shorter maturities on that. I don't think I don't think we're likely to see just a mass flood out of treasuries. It just seems really unlikely. There's not a lot of other places for that money to go. It's been going to gold. The euro has been a beneficiary, but there's still not enough collective European debt to act as a receptacle for all the money coming out of dollars. I mean, you're talking about dumping buckets or barrels into thimbles. It's just not a deep enough market for that to happen. So the treasury market is massive, and it's hard for anyone to find another place to put those assets. So again, less buying maybe, but not a whole lot of selling. The pace of selling in China has not changed. I'm looking at my screen. It's literally the exact same. Like you can put a ruler on this line since about 2000, and since right after the European debt crisis. So April 2013 to April of 2025, you could just draw a line. They're just declining in terms of their exposure to U.S. Treasuries, in part because the Fed bought a lot, others bought a lot. They haven't been buying more. They've actually been lowering their exposure. All these factors. So I wouldn't worry, again, about a sudden shock that international major governments are going to dump their treasuries because of the trade situation. It's just that they're going to be buying less, and that becomes an increasing burden here as we try and fund those deficits. I'll stop there.
Yeah, I'd add one more thing on that, which is that basically what you said is that the U.S. is not going to lose reserve currency status anytime soon because there's really no alternative to the large markets here. But we could see the dollar, continue to weaken a little. It doesn't take a much of a shift really for that to happen. And that could benefit international stocks, the returns for international investors, and we're seeing that this year.
Yeah, that last point's a really important one. So when the dollar goes down, generally means your gains translate into more dollars. So when you measure them in dollar terms, they look even better. The earlier thing you said was really important too. The dollar can retain its reserve status because it's the deepest and most liquid market is treasuries. But at the same time, the dollar can go down. I mean, we've seen periods where the dollar fell for a decade, year after year after year, still retained its global reserve status. It doesn't mean the dollar can't go down. It just means you're unlikely to see like an abrupt plunge in the value of the dollar, but it can certainly fade over time as it's faded this year. We think we're on a longer term path of a weaker dollar, but the dollar's reserve status could ultimately be challenged a decade or two from now, but it would take a long time to build up other bond markets around the world to be as deep and as liquid as the U.S. Treasury market. It can't happen overnight.
Thanks so much, Jeff. So as we look at performance of various countries, we do notice the U.S. and China somewhat are lagging compared to rest of the world.
Yeah.
Do we think that's a short-term situation that's going to resolve quickly, or do we expect that might be the start of a longer trend?
Well, I think it's sort of a longer trend, but there's certainly room for debate around it. If you take a look at just on the last year, the thought was, well, Trump's America First policies are really going to benefit the U.S., and the U.S. outperformed. And we cautioned at the time, don't read too much into this. Same thing happened in 2016 after the election. Trump won. America First policies are going to be great. And then, of course, 2017, the U.S. was the worst performing global market. Again, the U.S. the worst performing global market this year. And I think it's interesting to look, if you think, which economies are hit the hardest by these U.S. import tariffs? Well, countries like Germany, which export a lot of cars to the U.S. and cars being hit with all this. And then Mexico, the country most exposed to exports to the U.S. Which are the two best performing stock markets in the world this year? Germany and Mexico, both up 23% measured in U.S. dollars. So investing's hard, and it's just not as clear or as simple as it may seem on the surface. And that's why we were stressing last year. Coming into this year, we think, again, this is a year where the gap between the U.S. and international markets widens further with more international outperformance for a variety of reasons. The rest of the world's exposure to U.S. trade is like 5% of GDP, but it's far more significant for U.S. economy and U.S. businesses. And the U.S. is in a trade war with every other country in the world, and all the other countries are really just in a trade war with the U.S. In fact, China has been extending an olive branch to a lot of other countries, and actually unilaterally dropped sanctions on some European officials as an offer to say, hey, let's come to the table and talk a little bit here. So, China could find its way into offsetting the decline in U.S. trade with boosting its trade with other U.S. trading partners. And that could be an interesting take from this. So it's a way in which China could emerge from this a little bit stronger, actually, on the trade front, but they're really, as Michelle pointed out, focused on driving their own domestic economy, and they have the fuel to do that. And that could leave the U.S. as one of the laggards this year. Obviously, none of us know how this is going to work out. And over the long term, it's difficult to say, but in the near term, we know the potential hits here are pretty severe. I think that's why we're in a 90-day pause. Maybe that pause gets extended. Maybe we see some progress among some of the, 17 countries that Besant just said are, progressing along here in terms of trade talks. So we'll see what comes out of all that. And maybe those countries get an exemption, and we'll have to see. But in the near term, certainly there's a lot of uncertainty. Obviously, as I mentioned, that's weighing on earnings and the earnings guidance. And that's something that the U.S. is going to have a little bit more of a challenge getting over than other countries. I'd also note that U.S. valuations are quite high, meaning prospects, the expectations for earnings growth have been much higher than elsewhere in the world, and they might need to continue to come down a little bit. So even if earnings growth isn't negative, expectations for much faster double-digit earnings growth may get dashed here as we try and figure out what's next. So again, I don't know how this is going to evolve. I'm hopeful that we're going to see some trade deals, and the U.S. and China can catch up a little bit here and not lag by as much as they have so far year to date. But it's very difficult to see from here. And we continue to find the relative safer havens outside the U.S., including in economies like Europe, where, again, they've got their own somewhat domestic economic stimulus going, rate cuts going for them, faster earnings growth, fewer downward revisions, and much more attractive valuations.
Thanks so much, Jeff. Now, given all of this uncertainty that we're seeing, and we're at peak week for earnings, do we see a trend or a tendency for companies to withdraw forward guidance until they know more?
Yeah, I mean, sure. It's such a difficult environment. You'll hear more companies, I think, like what we heard from United Airlines last week, where they gave two scenarios. They said, look, you tell us, is it going to be a light tariff or a heavy tariff scenario? Then figure, here are two different areas of guidance. And so I think it is very hard. And so I think you're going to get analysts also with a very wide range of estimates for companies. Often, estimates only vary by a penny or two. We might see a very wide range with analysts having different views on how the future may progress. Management may have different views and may offer different scenarios. So that just creates a lot more uncertainty around what earnings are going to be. And when you have a lot of uncertainty, usually price to earnings ratios come down to reflect that uncertain forward earnings outlook. And again, I just think there's more vulnerability to that in the U.S. than in other markets where valuations are below their 10-year average, whereas in the U.S. they're still well above.
And a last question, if we have enough time here. With the rate outlook globally in the U.S., do you think that's going to affect the dollar? We do know that dollar and SPX correlation has been typically positive historically, but didn't follow the last little jump up. What are your thoughts there?
Michelle, you want to take that?
Well, I think the dollar isn't really acting as people expected recently due to these uncertainties about a trade war. The question was about earnings or about correlations?
The correlations with S&P 500.
Yeah, typically lower dollar would benefit companies with overseas earnings, such as in the Staples particularly, but a lot of those companies last week were talking about some hesitancy by consumers. We're seeing consumers, maybe holding back firepower a little bit. And one thing that was interesting too in the preliminary Purchasing Manager Index numbers that we saw, services was quite weak. And so that was kind of surprising. So I think we just have a lot of variables hitting earnings right now and corporate outlooks.
Well, thanks. Thanks for those questions, Heather, and thanks for helping me answer, Michelle, and and thanks to our producers, Andrew and Gabe, and everyone for the questions and for joining us. Make sure to tune in each week at 11 a.m. Eastern or catch the replay on YouTube, and also be sure to click like on the show and share your comments on what you're watching in the markets. And we'll see you all again next week.